And stock futures are up ahead of today's Federal Reserve interest rate decision. The Fed's been holding off cutting rates, citing uncertainty around the impact of President Trump's tariffs. But the president has repeatedly urged the Fed to lower rates, claiming it would save the U.S. $600 billion. Let's bring in Bankrate Chief Financial Analyst Greg McBride for more. Hi, Greg. Always great to talk to you. So what do you expect to hear from the Fed today?
Diane, no rate cut at this meeting. And frankly, we don't know how much longer they're going to be on the sidelines. We've seen a better trend on inflation, but the prospect of tariffs and the impact that that could have, it's kind of like waiting for the other shoe to drop. If it wasn't for that, I think the Fed would probably be in a position where they might be cutting rates right now. We have seen some softness in the labor market. That's been expected. But if it were to deteriorate further, that's the type of thing that could prompt the Fed to cut rates in the coming months. In the meantime, I expect them to just keep their options open and keep singing a lot of that familiar refrain that we've been seeing, just that there's a lot of uncertainty and that they want to evaluate more data so that they don't paint themselves into a corner.
So, Greg, if what you're saying holds true, if the Fed holds rates again, what does that mean for the average American watching right now?
We tend to romanticize the idea of interest rates coming down, but the why rates come down is really, really important. In other words, we want the Fed to cut rates because inflation pressures are receding and they can take the foot off the brake pedal a little bit. We don't want the Fed to be cutting rates because the economy's sputtering and it needs some extra juice. The reality of it is the economy's in pretty solid shape. Yeah, it's some softer growth, some softness in the labor market, which was expected. But the type of thing that gets the Fed to cut rates in a more rapid fashion, it's not that scenario you want to root for. It's the likelihood that we do see a deterioration in the labor market, sharper slowdown in the economy, and that's what prompts them to act.
Now, President Trump claims lowering rates would save the U.S. $600 billion. You've said it yourself, inflation stayed pretty steady over the last few months. The recent jobs reports have been pretty good. So why not lower rates?
A lot of that is because of the prospect of tariffs. There's just a lot of uncertainty about the tariffs themselves and what impact that's going to have on inflation, consumers and businesses. The sentiment has really plummeted in recent months. You've seen a little bit of a bounce back as those tariffs have been put on hold for a while, but consumers and businesses are expecting higher prices. And on some level, that can become a self-fulfilling prophecy. If businesses expect their costs to go up, they could raise prices to get out ahead of that. That's the type of thing that could feed into inflation. And so, the Fed really wants to evaluate that data before they commit themselves to a further path on interest rates.
All right, Bankrate Chief Financial Analyst Greg McBride, thank you.
Thank you, Diane.